2023 is drawing to a close, and it's been a year of several landmark cases in the Supreme Court. From same-sex marriage to Article 370, the Apex Court heard some of the most high-profile cases and delivered its verdict. The Adani Hindenburg matter was arguably the biggest corporate case of the year. Ashmit Kumar is here with the year that was in India's top court.
The year 2023 was a landmark year with several key issues being heard or decided by Indian courts. So here's a look back at the biggest news stories out of Court Corner. Arguably, one of the biggest cases was the landmark ruling by a 5-judge bench in the Article 370 case. A case that probably has more political repercussions than legal. The Supreme Court upheld the abrogation of Article 370. The Supreme Court held that J&K enjoys no sovereignty and that the Indian Constitution is applicable fully. The Supreme Court also hoped that statehood should be restored soon and that elections would be conducted before September 30th, 2024. Number 2, here's another high-voltage case, the same-sex marriage matter. It was again a ruling by a 5-judge bench. The Supreme Court gave a big no to same-sex marriages and to the fundamental right to marry. The Supreme Court also held that it's not the court's job to grant the right to marry to same-sex partners and that issue should be left to the government. Review petitions, meanwhile, have already been filed. Number 3, here's another case with big political implications, especially ahead of the 2024 elections. In March, the Supreme Court held that election commissioners had to be appointed by a panel of Prime Minister, Leader of Opposition and the Chief Justice of India. In August, the centre introduced a new law that replaced the CJI with a cabinet minister. Now, even as the parliament granted its nod, former Supreme Court Judge Rohinton Nariman claimed that this will hurt the Election Commission's independence and that free and fair elections will soon become a chimera. Number 4, Supreme Court also saw multiple rounds of legal contests between the Delhi and central government over administrative control over the national capital. In May, the Supreme Court cited the federal structure and granted Delhi government control over administrative services. Now, much like in the case of the Election Commission appointments, the centre again came out with a new law after the Supreme Court ruling and gave the Delhi LG the powers of administration. Number 5. This was the biggest corporate case of the year, the Adani Hindenburg saga. In March, the Supreme Court directed for a SEBI probe and asked an expert panel to review the regulatory framework in place. Now, in June, the expert committee came out and said that there was no regulatory failure and there was no evidence against Adani. In August, SEBI informed the top court that probe was completed in 22 out of 24 cases. In November, the Supreme Court reserved its judgment while observing that there was no reason to doubt SEBI's investigation. Number 6, Supreme Court also heard pleas challenging electoral bonds. Petitioners claimed that bonds were opaque and where only the government knew the donors. The centre submitted that voters can't have an overbroad right to know and that the Supreme Court reserved its judgment after that while flagging selective confidentiality of this scheme. And finally, number 7, this was not so much a case but rather an issue, a sensitive issue at that. Now, keep in mind, in 2018, 4 sitting Supreme Court judges held a press conference against the then CJI, Deepak Mishra. The judges had flagged allocation of cases, of specially sensitive cases, to specific judges. Now, cut to 2023 and similar concerns were shared by senior advocate Dushyant Dave in a letter to the CJI. Reports have cited how the case on judicial appointments was taken away from Justice Kaul and how some politically sensitive matters were listed for hearing before Justice Bela Trivedi. Now, with the Supreme Court scheduled to hear the CAA case as well as the review of the same-sex judgment matter and also likely to deliver its judgment in the Adani Hindenburg case as well as the electoral bonds case, 2024 is already looking like a busy year for the top court.
Well, away from court matters now to money matters. India's banking sector is in good shape and the Nifty Bank Index is up over 10% in 2023. Asset quality is the best that we've seen in a decade, but valuations are still below pre-COVID levels in many cases. Abhishek Kothari wraps up the year that was for Indian banks and tells you what's in store in 2024.
We all know that the banking sector's fundamentals with respect to return ratios and credit cost are the best and lowest respectively in a decade or more. Now, asset quality of the banking sector is the best in 10 years or more, which has been aided by decline in slippage ratio as well. So this has been on account of the cleanup exercise taken by the banks earlier. Now, loan growth has returned to the banking sector after a long time. Deposit growth has also been very healthy. However, the valuations are not defining the sector's true fundamental picture. Valuations of many banks are below the pre-COVID levels or below 2019 valuations that were seen. This despite the fact that the bank's capital adequacy ratio, provision coverage ratio are one of the best that you are seeing in last decade or even more. So to put valuations into context, we need to understand how they were in terms of movement seen pre-COVID between FY09 to FY19. During this period, the highest valuation gain was seen for the banks like IndusInd Bank, ICICI Bank, Federal Bank and Axis Bank. In fact, the most expensive stock was Kotak Mahindra Bank, followed by HDFC Bank and IndusInd Bank. Now, post-COVID, the valuation picture of banks have seen a lot of change. ICICI Bank, Bank of Baroda and State Bank of India are the only lenders to witness expansion in their valuations from what they were in FY19 to what they are in FY24. Many banks are still trading at FY24 valuations that are below those that were seen in FY19. These includes the names like IndusInd Bank, Kotak Bank, HDFC Bank and Axis Bank. Net interest margins of lenders can moderate in the first half of calendar year 2024 given the fact that cost of funds will continue to weigh in. Return ratios, that is return on assets and return on equity, will remain healthy at least in H1 CY24. Now it may moderate a bit but not significantly. Watch out for the credit cost in unsecured segment on which RBI has raised certain concerns. Some players may feel the heat on this segment. Deposits and advances growth to remain healthy for the banking sector even in calendar year 2024.
Well, retail investors have had a good year in the stock markets, but 2023 was also the year that the mutual fund space took its foot off the gas when it came to new fund offers. Shivani Bajaj details the trend and explains the reasons behind it.
Well, mutual funds in India have had a splendid run over the last few years, and when 2023 began, it was expected that this year would be no different. To a large extent, it was not. As of November end, MF inflows have come in at 49 lakh crore rupees, with 40% going into equity funds. The difference this year, however, is the number of new fund offers that were launched in this year. Now, remember, NFOs are how fund houses typically cash in on new trends and opportunities. So, the fact that only 191 new fund offers were launched this year is telling. I say only 191 because this number is less than the 228 NFOs launched in 2022. 2023 has also seen relatively lesser money coming into mutual funds through NFOs. 53,000 crore rupees, which is 13% less than 62,000 crores raised through this route in 2022. Now, experts and industry watchers say that one of the biggest reasons for the significant decline in the number of new launches this year is the change in debt taxation. The Finance Act of 2023 removed the benefit of long-term capital gains tax for debt mutual funds. Essentially, it said that gains made from mutual fund schemes that have less than 35% allocation in equity would be taxed as short-term capital gains, so now at 30% instead of the earlier 10%. This would apply irrespective of the period for which the units were held. In effect, what it did was it turned investors away from such funds, specifically the target maturity funds. TMFs had seen a surge in popularity in the previous 2 years because they were open-ended funds and offered a fixed rate of return. Now, to give you a sense of their popularity, between January and March 2023, 31 new passive funds were launched and all of them were target maturity funds. However, once the new tax rule kicked in from the 1st of April, guess how many TMFs were launched? Only 3 after April till December 1st. Of course, new passive funds continue to be launched, but they were mostly in the equity space. Overall, in 2023, 50 new index schemes were launched and these together cloaked inflows of 2,500 crore rupees. In contrast, in 2022, 84 index funds were launched, most of them target maturity funds, and inflows in these schemes came in at 11,235 crore rupees. To be fair, through the slowdown in debt mutual funds has been the only big bump in the road for mutual funds in 2023. In all, thanks to the bull run in the equity markets, business has been good. There were 45 equity NFOs in all, raking over 30,000 crore rupees by November end. Sectoral and thematic funds saw the most buzz between January and the end of November. 25 new sectoral and thematic funds were launched, garnering around 13,000 crore rupees in their NFO period. The big draw, however, were funds focusing on infrastructure and public sector undertakings. Several themes like infrastructure, PSU theme and banking sector were played via business cycles funds and quant funds. This interest has been rewarded as well. Thematic funds have offered year-to-date average returns of 54% to investors, and infrastructure funds have given average returns of 42% year-to-date. New fund offers also were launched in diversified categories like multi-asset funds and multi-cap funds. They have also continued to attract investors in 2023. Now, 6 new multi-cap funds were launched, garnering around 7,200 crore rupees. It also saw 6 multi-asset allocations funds, NFOs, garnering over 6,500 crore rupees in 2023. While multi-cap funds offered year-to-date returns of 31%, multi-asset funds also offered close to 20% returns to investors. So overall, the mutual fund industry has had a good year, and barring the jolt from the new taxation rules, has been riding high on the bull run and giving investors fatter wallets.
Well, time for us to head to a short break, but when we return, we take a look back at the performance of other asset classes in 2023, especially commodities, and also a closer look at what's been a tumultuous year for online gaming companies. We're back in 2 on Rewind 2023. You're watching CNBC-TV18. Now, 2023 has been a year of conflict, from Ukraine to Gaza to South Sudan. War is raging across several parts of the world. Geopolitics has largely shaped the movement across commodity markets. Manisha Gupta is here with a wrap and tells us what's in store for investors in 2024.
2023 can best be described as a year of conflicts among countries, erratic weather and high interest rates. As per a Bank of America report, there were 300 rate hikes across global central banks from 21 through 23. But 2024 could see around 152 rate cuts, and that would be the major theme for commodities. Apart from the current geopolitics and China recovery hope, the impact of higher interest rates and the currency factor would also be in play, as would be the green energy transition and the move away from fossil fuels. Let's start with the crude oil prices, which are headed for an annual decline, the first one since 2020. The prices did trade in a range of $70 to $96 a barrel. 2023 was all about OPEC Plus cutting output and record high US production. And then the COP28 transitioning from fossil fuels put some more pressure towards the end of the year, bringing down the 24 outlook, with Citi least bullish with $75 a barrel of a price forecast, while Morgan Stanley, JP Morgan, Goldman Sachs projected crude within $80 to $93 a barrel. Talk about silver, and that has globally hit multi-month highs, but hit an all-time high in the Indian markets for the year. There are concerns about global deficit, strong demand and the rupee depreciation. Prices gained more than 5% with projections of higher highs in 2024. Gold prices hit an all-time high in 23 in US, in China, in Japan, in Korea, Taiwan, Australia and India and various other countries. The view on the next year is of higher highs up to $2,200 an ounce. Talk about industrial metals, and there were contradicting fundamentals of supply disruptions and weak demand on the other side. 24 could support the green energy buying and improving Chinese demand. I'll start with nickel, which was the underperformer in the pack with 43% decline in 2023. 24 forecasts are put higher through and through in this metal. Zinc, and that is the second worst performing LME metal this year, slumping 16% as weak construction activity has hit the metal's main use in galvanizing of steel. But zinc is also expected to do well, with forecast anywhere between $2,150 to $2,650 a ton. Aluminum prices are also closing 23 with a negative of 2.5% as supplies idle capacity in Europe and China comes back online. For 24, it's a higher target set by global experts. And then it's copper, where the prices are headed for a marginal 2.5% gain in 23 after a very volatile year, as the street believes that with new projects coming online, it could be a state of demand. Well, the demand will start to pick up, and that would be supportive. So 24 price outlook ranges from $8,300 to $10,000 a ton. And finally, it's about iron ore, the last on my list, which is the best performer in metals with 23% of gains, and with expectation that going forward in 24, you could be looking at prices averaging at around $100 a ton.
2023 turned out to be an eventful year for the online gaming industry in India. The dynamic landscape of the industry, which emerged as a new age sector with immense perceived economic growth potential, investments pouring in and rising popularity, had the government seeing red. Timsy Jaipuria details how the government's decision to tax this sector has the industry sweating.
When 2023 began, online gaming companies were having a ball. Widespread smartphone penetration, enhanced internet connectivity, and a growing youth population meant business was booming. Industry estimates suggest that India's gaming community had attracted over 42.5 crore gamers, the second largest globally after China. This has helped the industry clock a CAGR of 28% between FY20 and FY23, hitting a market size of 16,428 crore rupees in FY23. The real money spinner here was the real money gaming or RMG segment. This accounted for 82.8% of the online gaming market share in FY23. The rising popularity of this segment prompted the government to increase regulatory compliance requirements. So, on the 2nd of January, it proposed amendments to the Information Technology Rules 2021. These included registration of gaming intermediaries with a self-regulatory body, KYC processes for users, disclosures on fees, charges, and the processes for depositing and withdrawing money, privacy and data protection policies, and appointing a chief compliance officer and a grievance officer with a set timeline to respond and dispose of complaints. Less than a month later, the union budget threw the sector a curveball. For online games, it proposed to provide for TDS and taxability on net winnings at the time of withdrawal or at the end of the financial year at 30%. Moreover, it removed the 10,000 rupee threshold for calculation of TDS. The idea was to plug any loophole that allowed unreported income. But higher taxation was not the only problem these online gaming companies were set to face. Acting on a spate of suicides and attempted suicides sparked by heavy losses in online money gaming, the government of Tamil Nadu and Karnataka brought in laws banning such games in their states. These quickly turned into legal battles that are far from over. Meanwhile, the government's tax machinery continued to plug what it believed were lapses in payments. Gaming company Gamescraft, for instance, received a 21,000 crore GST demand notice from the DGGI and had to seek relief from the Karnataka High Court. The court in that case was of the opinion that rummy is a game of skill and cannot be considered similar to betting or gambling activities. But this relief was short-lived. On the 11th of July, the GST Council announced the decision to levy GST at 28% on the full face value of deposits made by gamers.
Online gaming, horse racing and casinos will be taxed. They will be taxed at 28%, each one, and they will be taxed on full face value.
This opened up ruling in the Gamescraft case to challenge. Even as this special leave petition went to the Supreme Court, Parliament passed the amendments to the GST enshrining the 28% GST on online real gaming into law. This would kick in from 1st of October. The government's case got a big fillip on the 6th September when the Supreme Court stayed the Karnataka High Court order quashing the 21,000 crore rupee GST notice issued to Gamescraft. This opened the floodgates to more such notices. The Finance Ministry has told Parliament that up till October, as many as 71 show-cause notices have been issued to online gaming companies for financial year 2022-23 and 23-24. Together, these involve GST to the tune of 1.12 lakh crore rupees. However, since these notices are pending adjudication, the exact GST demand is yet to be determined. Experts also agree that the government should not move with too heavy hand when it comes to the taxing the real or the online real money gaming, because this segment is expected to contribute between 6,500 to 6,800 crore rupees in direct taxes, including TDS and corporate tax, and a further 75,000 to 76,000 crore rupees in form of indirect taxes over the next 4 years.
Well, with that, it is time for us to wrap up this edition of Rewind 2023, where we took stock of the year that was, but more importantly, look ahead to the year that is ripe with possibilities. On behalf of the entire team at CNBC-TV18, here's wishing our viewers a very happy, safe and prosperous 2024. May you return to your TV screens with renewed vigor, enthusiasm and confidence, and we will be there just as we have been over the last 25 years, your trusted ally and partner. From all of us, goodbye, thanks for watching and Happy New Year.